Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrouther, Director of Business Development.
On this show, we talk about real estate investing, business,
and so much more.
Welcome back to another episode of the LSCRE Podcast with a really cool model we're going to be talking about today. I've got Alex Zahn, part of the investor relations team, investors concierge, some would say, with the Sunrise Capital Investors team. How are you?
I'm doing terrific, Craig. How you doing, my man?
I'm doing great. It was great to see you, and thank you so much to the team for being in full force, you and Johnny, at our LSCRE Summit event not too long ago, obviously in September. We really appreciate you guys showing up, sponsoring, and being awesome people, and ultimately adding and providing good color and culture to the alternative investment space. And speaking of alternatives, I definitely think you guys put the alt in alternatives, particularly with some of the models you guys do, the differences you guys have to offer. And, on this podcast, you're going to notice a theme that, it's not all about multifamily. It's not all about just talking our book. It's kind of educating people on other really cool options that maybe if you're looking to diversify your holdings and also your structure, individuals like this are great custodians to learn from and to kind of connect with. But Alex, before we get into the Sunrise team and kind of your model and your fund structure, would love to learn about your backstory and how you got to where you are today. Because you've been at the team for a couple of years now at this point, I want to say.
Yeah, about a year and a half. And then in the real estate space for pretty much since I graduated college. So back in 2021. So again, incredibly excited to be here, Craig. And if you want me to jump in, be happy to do so.
Yeah, go ahead first.
Perfect. Awesome. So just a little bit about me, just a country boy from Wisconsin who kind of stumbled into real estate pretty much right out of school. Story very similar to others, stumbled upon Rich Dad, Poor Dad, which got me thinking about real estate. And I started working for my first mentor back in, that was a few years ago now, for 2.5 years. So he is a mobile home park operator and investor in Wisconsin. So I was a property manager for him for a bit, and just to learn that space, then I got transitioned to the sales side. So I was in charge of, if there was a park-owned home that we wanted to turn into a tenant-owned home, I was in charge of getting a contractor in there to get everything remodeled and then sold. And I was also in charge of all the infill. So, applying for all the permits, getting the utilities ran, the slab poured, the home moved on, skirted, staired, and then sold. So did that for 2.5 years, kind of grinding my teeth with the operation side. So that was fun. Then I worked for another private equity company for, that was roughly a year as well. And I started off for them as an intern just on the weekend because I knew that I wanted to get into the capital raising space and, transition into full-time with them for a while. And then I stumbled upon Sunrise and, hopped on a call with Brian, who's one of our principals. Then I just fell in love with the model, the culture, the overall mission. And I've been with these guys for about a year and a half. And at Sunrise, my main job is to be a main point of contact for all of our current investors. So, if they ever have any, questions, concerns, comments, or if they ever want someone to BS with, they give me a call. Then, I hop on, talk shop, answer all the questions. And in addition to that, I help my colleague, Johnny Katani, out with the fun stuff as well. So, certainly stay busy.
Without a doubt. And what you guys do at Sunrise is a bit unique. So for those who are not fully familiar with the team and company, can you kind of give the historical rundown about when you were found, assets under management, and then I guess we'll go from there after.
Yeah, absolutely. So, founded by Kevin Bupp and Brian Spear. And for those that don't know Kevin, he's somewhat of a legend in the real estate space. He I think he started right when in his 20s and, started in the single family game. Unfortunately got hurt, pretty bad in the 2008 crisis. So then he transitioned to, more of the commercial stuff, stumbled upon mobile home parks back in, I believe that was around 2012. And him and Brian were just raising money from friends or family, and then rolled out the first formal fund structure back in 2017. And now we're onto Fund 5, which just opened up a couple weeks ago, and assets under management were a couple hundred million, between 300 to 400 million, and we're growing quick. I actually just brought another team member on to help me out with current investors, and we have some exciting stuff in the pipeline, not just with assets, but the overall structure and everything that we have going on.
Yeah, and then let's talk about some of the assets that you acquire, because it's everything from parking structures to mobile homes to some stuff in between. So can you talk about some of the strategies that you guys have that would differentiate yourselves from what you typically hear from the typical alternative space sponsors?
Yeah, absolutely. So we are big fans of if it's not broke, don't fix it. So Kevin and Brian were actually some of the pioneers. They did mobile home parks before mobile home parks was cool. Yeah. So we've been in the mobile home park space for like I mentioned, since at least 2012, maybe a little bit before, and then transitioned slightly over to a relatively similar business model, which is parking assets, parking garages, parking lots. And the reason I say that similar is that we actually like to run our mobile home communities similar to that of a parking lot, that we don't like to actually own the homes themselves. We would prefer for the residents to own their homes, and a bunch of different reasons that I can go into why we prefer that as well. And we thought the two asset classes were just very symmetric with what we want to do and what we want to accomplish as a company. So those are the two asset classes that we specialize in, and we don't touch multifamily. We let operators like Craig and Rod in, and so we stay in our lane, and we like to think that we're pretty good at it.
Yeah, so mobile homes, RV parks, right, and parking structures.
Just mobile home communities and parking structures. Yep.
So people are going to be thinking to themselves, why the heck parking structures? Can you give the thesis behind this? Because first time I heard it, I was like, wait, what? And then I was like, oh, I see why. So can you elaborate on that one, please?
Absolutely. So the reason that we like both of these asset classes is that they're both going down in supply, and specifically mobile home communities up in demand. And if we want to hit on just parking, it's more of a cash covered land play. So we buy parking facilities in very dense areas. By way of example, for Fund 4, we acquired one in Philadelphia, which is, I believe it's roughly a block from the Liberty Bell. So it's just irreplaceable real estate. And we also acquired one right across the street in Charlotte, North Carolina, from the Bobcat Stadium. So, in the meantime, the land value is going to just keep on going up and up. So the reason why we call it a cash covered land play is that, in the meantime, we'll keep on getting, the cash flow, which, historically, the parking lots have been, some of the best performing assets in our portfolio. And then, eventually a developer is going to come in and, think that there is a higher and better use for the land, which whether that be a hotel, a commercial building for office, and, they're going to end up, purchasing the parking garage from us primarily just for the land and then redevelop it. And which at that time, we like where we're at with those, since they, like I mentioned, the land values, it's irreplaceable. So it's more of a cash covered land play with that.
Yeah. So when you think of parking structures, it's a bit unique, right? But ultimately, for the investor to think about this, if you go to urban centers, they're really not making any more of those. So typically speaking, cities are actually trying to de-incentivize people who are even driving, generally speaking. They want these to be walkable cities. They want people to take Ubers, generally speaking, ride sharing services, public transit, stuff like that. So because of that, you think about this asset class, they're rarely, if ever, going to be building more kind of structures and inventory like this, right? So they're not going to be building this anymore moving forward. So number one, anytime you can buy something holistically that they're not going to be building moving forward, there's just intrinsic value on that. So that's number one. Secondly, if you're not going to have supply coming online, that's great. And then obviously where are these, structures located? Generally speaking, Alex, you have to agree they're probably going to be in, solid downtown MSA markets and whatnot. Is that typically correct?
100%.
Yeah.
Yep.
And then above and beyond that, the upkeep on these assets is quite low. Think about multifamily, turning over units, pretty expensive, obviously. It's doable. If you're vertically integrated like us, you get better economies of scales and efficiencies, right? But or even hotels, very labor intensive. I imagine an asset like this, Alex, is essentially no labor whatsoever, maybe a couple of people tops, and you're kind of covered there. Can you kind of walk through the mechanics of that?
Yeah, exactly. Yeah, you nailed that right on the head. And yeah, that's why I mentioned the kind of symmetry between the mobile home parks and the parking, because they're both we like to run them both very the same as it relates to management. So we actually do sub the management out for the parking community, or the parking lots, and it's actually the same company that Sam Zell used for managing those parking assets. And yeah, very very, I can't think of an asset class that's more user friendly as it relates to a management aspect. Exactly like you mentioned. Like, I own multifamily myself, and I know it's a pain in the neck when residents move out, in which multifamily residents tend to move out quicker versus mobile home communities. So yeah, overall, just the high level management of a parking asset, it's hard to beat.
Yeah, and then can you kind of talk about, just so we can kind of go apples to apples compared to other real estate classes? When you acquired a property in Philly, I'm sure that'd be probably a pretty tight market because obviously it's great. And one cool thing about it as well is, whether it be industrial real estate or self storage, not really any rent control on it. So if you're in, the New York location or these locations like this, you're not really restricted by, local bureaucracy, even if you're in a blue market, as opposed to, some housing stuff like that, which is obviously a nice moat where you get market exposure, but you don't get the market downside in some respects, I have to imagine. But can you talk about the kind of the breakdown of the economics from a cap rate, expenses, stuff like that, so we can kind of mentally compare it? Are you getting these things for like a 5 cap, a 6 cap? Like, how would you kind of underwrite that, or go or I guess assess it so it's more like for like?
Yeah, no, for sure. And yeah, to my point earlier of, everyone on the Sunrise team more so staying in their lane. So as it relates to, actually acquiring these assets, I mean, that's Kevin's bread and butter. And he would know, a lot more as to, what it goes into as it relates to the marketing for these properties, and, the exact cap rate. What you threw out for the cap rate is roughly where it falls into. However, as it relates to actually underwriting, yeah, I'm gonna stick in my lane. Not my expertise for this, and yeah, that'll be more so for Kevin.
Yeah, can you give like a ballpark cash on cash projection as to what that kind of looks like that asset maybe spits out typically, or maybe the debt structure
Absolutely.
that you put together, something like that, just so the audience can kind of get a feel of what that looks like?
Yeah, absolutely. Yeah, 10+% cash on cash usually. And the reason why, we're able to, get such a high cash on cash is that, we solve complex real estate problems. So, I mean, we can go for this parking facility actually over in North Carolina. So it's a technically one city square block that has a hotel attached, and then a office building attached as well. And Kevin being the genius, Kevin and Brian being the geniuses that they are, only carved up the actual parking facility. Since, going back to our point, that we like to stay in our lane, like we don't, the people do awesome at hotels, people do awesome at office, but it's just not our bread and butter. So we actually carved up that asset and only purchased the parking facility, which allowed us to get such a good deal on it, and allows us to cash flow what we do with it.
Right. And then, from I guess, and then going into mobile homes, what do you look for there? Do you look for more tenant occupied? Do you look for more owner occupied? Is there a preference there philosophically at Sunrise that you do? And I guess, where are those assets typically located that you're acquiring?
Yeah, no, great question. Yeah, as it relates to mobile home communities, we do like to, if we have a preference, we would not own any mobile homes inside of our communities. And the couple big reasons behind that, first, the debt. In order to get Fannie or Freddie, they require I'm trying to think of the exact percentage, but I believe it's over 80% of homes to be owned by the community members. And then, second, just pride of ownership. If someone owns a home, they are going to, more likely than not, keep it in pretty good, shape. They're going to keep the yard looking good. They're going to keep the exterior of the building looking good. Then number three, if they own the mobile home, then they're less likely to pick up that home and move out of our community. And number one, with Brian growing up actually in a mobile home community, he sees every single resident, especially single mothers, as his mom. So we treat every resident, it's the core of everything that we do at Sunrise. And with that, we like to provide the highest quality experience at the a price point that's slightly a little bit below market value. So that way, people have no reason to move out. And, if someone does decide that they, want to pay the, $5,000+ to move their home out of the community, then they really don't have another option that's more cost affordable due to, where we're at in the marketplace. So to answer your question, if we had our way about it, we wouldn't own one home in any of our communities. I would say we're roughly 20% of the last I heard of park owned homes versus tenant owned homes.
Gotcha. Yeah, it's very interesting, that model there. For people that don't realize, when you see a mobile home, there's tenant owned, tenant owns the property, so they basically own the land. They own the land, but they own the trailer, versus someone leasing it. And naturally, at that price point, it becomes a little more challenging for someone at that income demographic to really care about the product if they just don't own it, right? So imagine if you had a unit where someone theoretically owned it and leased it back, right? Well, in our, that's, obviously more creative. It's like kind of, almost like a condominium style there, but just going to be taken care of better. And then they can sell it on the back end, obviously. And sometimes, people even offer seller financing and stuff like that, but I don't imagine that you guys do that. But it is an interesting kind of angle within that mobile home sector there. So going into, now that we know your strategy, can you kind of tell us about Fund 4, which I believe you closed, correct? Is that fully done? And can you kind of talk about, the fund structure and strategy? Because that's also the different nuance here, is that, for us at LSCRE, we do single investment offering syndication style. Okay. So basically, exactly what the property is, the location, yada, yada, yada. What they do at Sunrise, they basically say, hey, we're going to acquire X amount of properties in X amount of time. And then you're basically buying into that pooling. And then you get the cash flow based on the grouping of that. So can you kind of talk about the strategy, what you did for the Sunrise Fund 4?
Fund 4.
What was in it?
Yeah, absolutely. So it was 15 assets in total. So it's 2 parking facilities and then 13 other mobile home parks. It has a Midwest feel to it. So by way of example, we own a good amount of the communities in Ohio, Indiana. We have they say it's a 4-star. I don't know how there could be a 5-star if that's not a 5-star.
Sounds a little like an oxymoron, but I actually had someone else on the show talk about that recently, the stars of it and stuff. And he's like, he won't look for less than a 3-star. So
yeah, absolutely. So that one's in
mobile home, which is an oxymoron.
I hear you, man. And with my job prior to Sunrise, I mean, I've been in some quote unquote trailer parks, and the communities that we buy, they are very high quality. There's no hitches on them. We do have all of the management in house for the mobile home park side, so we keep all of our communities in top shape. But as it relates to Fund 4, so ended with 15 total assets, 13 mobile home parks, 2 parking. We opened that up in, I believe that was November of 2023. So it was open for roughly 2 years, and raised it was about $140 million in equity that we raised, and we're very, very excited about it. The overall structure of Sunrise is, very different compared to a lot of other shops that are, almost glorified, fix and flip. Obviously it's a lot more complicated than that. We do have a long-term outlook in mind, especially with the the pain that a lot of operators experience within the last couple of years, with interest rates rising like they did. We just kept on trucking along. It's been 32 straight quarters of paid distributions. Never had a capital call, never lost a penny of investor capital. And that is due to, us mainly going for singles. And, every now and then you hit a double, triple home run. But, we like to stay in the game since, if you have a 40+% IRR, that's awesome. However, if you invest in another deal and you lose all that money, anything times zero is zero. So, that's why we do have the long-term outlook in mind. And, with that, the overall return structure is that, over a 10-year period, it's a 14 to 18% projected average annual return. And that's inclusive of cash out refinances. And, that usually happens around, say, year 4 or 5. Until that point, we were projecting, I would say year 3 to 5. And until that point, we're projecting 6 to 8% cash on cash. And, after, I mentioned the long-term outlook. So, most people do, 3 to 5 year hold period. And, at that 3 to 5 year mark, they sell, which, when you sell, it's awesome as long as, you sell at the right time of the market. Given that, let's say that you did, buy right and sold right, when you sell it, it's cool. However, it causes two different problems to have. One being it's a capital event, so you have to pay any necessary tax on that capital, whether it be capital gains, depreciation, recapture. And then number 2, you have to, find another investment vehicle to place that money. So that's why we switched to the, buy with a good margin of safety, have a proven way to increase the value of those properties, perform cash out refinances to essentially de-risk the investment from our investor standpoint by getting all their chips back off the table and, paying them 100% of their capital back to them. And then, they stay in the fund for however long we end up holding the assets. And we tell all of our current investors and, new prospective investors to come in with the 10+ year outlook. And, that's why, we do have that long-term view on it. And, so it's not a get rich quick. However, it's a
wealthy circuit play.
There's no promises, but it's a much higher likelihood of getting wealthy over the long term.
Yeah, no, and I love that model and structure. I think how we're going to be doing stuff at LSCRE, right now, I think you can make the argument on our end for our market. And I love how you caveated so many things there, by the way. So it's very nuanced in that regard. But we're looking around like, hey, right now, a 5-year hold makes sense with fixed rate interest only during the duration. Now, we might have a situation where the exit market's not as sweet as we'd like. And we could probably, as you mentioned, take some chips off the table or turn them back into a refinance. But, we're looking to do deals, especially when the cycle changes a bit, because we're going to get hot at some point, right? There's going to be rate relief.
100%.
The market will feel good. Sentiment will feel good again. And we're going to be looking around like, hey, we're going to do deals because we know the market's kind of hot right now for 7 to 10 year debt, because there's a very good chance that we might get caught in the middle of the cycle halfway through this deal. Now, that's not to say that, we're going to necessarily hold every deal for 10 years, but we might do a deal for 7 years, 10 years, and refinance some money back, keep you in it, but return maybe all of your principal, but it wouldn't really make logical sense to sell. So
tax-free as well.
We're looking to do stuff like that as well. But I love that you guys have that model. And I think more people in safe and good deals promotes good culture and more investment. So that's why I really like what you guys do, because holistically speaking, when you do model things out like you're doing for that 7 to 10 year run, that's awesome. Now, when it comes to these deals, my question is, so I guess just to go back to Fund 4, you did 2 deals that were parking structures, and then 14 you said that were mobile homes. Is that correct?
13. Yep.
Okay, 13. And who manages your mobile home parks? Is it third party managed? How does that kind of work? And then do you have any sort of geographical focus? I know you mentioned it's a lot of Midwest, but would be curious to know if there's any strategic strategy if you look in, other, more of the sunshine states, the Sun Belt, stuff like that. Can you maybe talk about, focuses you have there? Or is it all kind of value oriented? So I guess to go over, deals, are you vertically integrated on the mobile homes? And then is there a geographical focus, or you just go where the best deal is?
Yeah, absolutely. So we could start with the management side. So I believe that was roughly 2 years ago. We hired a president of operations, so Todd De Leon, And to answer the question, very straightforward, we are vertically integrated for property management on the mobile home community side. And Todd took a shop that is similar in size to, what we were at the time, to, a couple billion in assets under management in the mobile homes parks, sector. So, I mean, he is just incredibly educated, probably the most educated guy that I've spoke with as it relates to, managing communities and, what it takes to, keep, the NOI up, the operating, the rent coming in, keeping the delinquency low and, minimizing the expenses as well. So yeah, management is all in-house. Kevin and Brian tried the third party route for mobile home communities, but separate to that of, what you specialize, Craig, multifamily, there's not a lot of good third party operators, if any at all.
Which is right. It's kind of,
yeah,
someone could get reallocated or repositioned within the company, or if someone has a problem with their manager or whatever, they may be out of that property who is really the kind of the driver there and the tenants end up loving, and that person goes away, you may lose your talent, right? So vertical integrations, although no one wants to be in operating because it's not fun or sexy, is the way to do it.
It's how you make money, man. No, you can buy a great deal, and if you operate it, I won't swear. If you don't operate it well, then I mean the deals are just not gonna. SOL, that's a good way to put it. Yeah, it's just not gonna pencil. Versus you could buy a deal at a pretty good price. However, if your operations is on point, I mean the return on investment's gonna be far and above that versus someone who does not have the a true finger on the pulse of management. And the only way to do that in the mobile home park sector is to have it in-house. So, we have, let's say about 40 the last time that I heard on the management side. I don't really deal all that much on the management side. However, I'm still, talk to Todd, and we have a couple cool things inside of Sunrise. So I talk to, on-site community managers. I talk to regional managers, and just overall for what we've gone through. The only way for management to truly work out in the mobile home park sector is to have it in-house. So that's why Kevin and Brian did bring it in-house after trying a few different managers, and just didn't seem to work. So
unfortunately, if you want things to be good, you got to do it yourself, right?
Unfortunately, man. Unfortunately.
Care about it and have enough upside as much into it as the person who is doing it or who is owning and operating and raising the equity, right? So if you're going to put that responsibility on your shoulders, you might as well go all the way through it. So, I can appreciate kind of that sentiment.
Absolutely. Yeah, there's three legs to, any private equity company. There's the capital raising leg, there's the management leg, and then there's the part that's going out and actually looking for the properties. If one of those legs is broken, I mean, you're just not going to be successful for the long term. So that's why,
ironically, although we're hyper focused on it, capital raising is the least important it's the most important, but also the least consequential to the outcome of deals, obviously, right?
Yeah.
So, you'd rather have the company.
100%.
You'd rather the company that's got the lamest looking marketing, the most boring stuff ever, that's like really unsalesy, but they've got wicked operations, as opposed to the most flashy, incredible looking decks, but the worst management and operations, of course.
100%. Yeah, and that's why management's so important to talk about. And a lot of investors don't really hit on that. For new prospective investors, I wish they did. However, the two most important questions that I would ask, prospective companies that I were to invest in is, number one, track record. History does repeat itself. And, if you have a track record of not performing to the standard that you say that you're going to, I would run personally. And then number two, is management. People invest with companies, like Sunrise, like, Lone Star to be passive. And, that pretty much enables us to not be passive. And, exactly like you mentioned, the unsexy part of real estate that nobody likes to talk about is management. And that is where the true money is made.
Yeah, I love that. So then let's actually go to leverage perspective. I think you mentioned you raised about 120 million for Fund 4, which congratulations, it's awesome. Do you know tentatively the leverage that was taken out on the acquisitions that you guys did from a debt to equity, or I guess ratio? Was it like 40%, 50% capital down? I'd be curious to know that.
It's about 55% LTV
Yeah,
on
that's
average.
awesome. That's about as delevered as it gets in the space. That's probably why you're able to probably, stabilize these deals, increase the value, and then obviously, ideally around that 5-year marker to cash out, a lot of the chips, particularly when value increases and stuff. At that point, the time value money equation really starts to probably kick in, and you want to kick out, some of the initial capital. So future looking
Mm-hmm.
here, Fund 5, is your goal to have a similar ratio, like basically call it for one parking structure, 7 mobile home properties, or is it just really cyclical with regard to parking structures being on the market because, there's such rare assets in the sense that you own them, you don't really want to get rid of them, right? So holistically, do you guys have goals like that, or is it kind of best deal is the best deal and you go from there? Can you talk about that? And then I guess to start.
Yeah, absolutely. Yeah, we played the game where the goalposts are. So, we don't deviate from mobile home communities and parking facilities. However, we're not gonna buy a bad deal. Specifically, I'll kind of double tap on Kevin's history, and he built himself up to a multimillionaire in his mid-20s, and could do no wrong. As I'm in my mid-20s, so I can kind of understand his thinking. And then 08 happened, and he did do wrong, as well as the vast majority of real estate investors. So yeah, going back to that LTV, that's why we never get into a over our skis in debt. And that's why we always make sure that if a deal does not pencil, going back to your last question, we're just not going to buy it, because Kevin doesn't want to go through that again. He's not going to put his family through that. And then hand in hand, if Kevin and Sunrise does well, then the families of the investors that invest with us are not going to go through that. So yeah, we play the game where the goalposts are. We love both asset classes. Historically, we bought about roughly one parking facility a year. Not saying that's what's gonna happen in the future. Because the mobile home park sector is our bread and butter per se. So yeah, we don't really have any necessary goals as to we want to buy X number of mobile home communities. We want to buy X number of parking facilities. Yeah, we're just going to buy whatever truly makes sense.
I love that. Coming up here, so you're going to mention. So do you have any raising goals for Fund 5 for Sunrise?
Yeah, so it starts at a $50 million capital raise for Fund 5. Then we have the option to extend that as needed. So yeah, as it relates to capital raising, I mean, we raise money to buy assets that we need. So we have a very, very healthy pipeline of, kind of like I was talking about earlier. We have one park that under contract to buy, 5 more mobile home parks under contract to buy, a parking lot actually out your way in Phoenix that I can't talk about too much, that we just talked about, or I just learned about a few days ago. So yeah, we have a very healthy pipeline to finish off 2025, and in which if we want to hit on depreciation, which we always say we don't let the tax consequence wag the investment dog.
Thank you.
However, historically, we've been able to offer roughly 90% of 90 cents on the dollar for every dollar invested of depreciation. And for Fund 5, we should we're cautiously projecting 80+% of depreciation. And it just goes back to why mobile home parks are one of the reasons why we love them. It's not just for the
proportionally awesome. So just like Sunrise does, we take out less leverage than our competitor, but our deals, just the way the tax code works, completely works differently than what a car wash would do or what a mobile home park will do, which I'm sure you're about to get into, but just for some clarity there. So if you're a big depreciation person and you're looking to really max it out, you should probably reach out to this individual and talk to your CPA and tax advisors, of course.
Exactly. Yeah. Yep. No, not a CPA,
No
not a tax attorney.
Yeah.
Yep. Always talk to, everyone's tax situation is different. And it's always smart to talk to, your tax professional. However, we have had, and with saying that, we have had just got to be careful. And with saying that, we have had a lot of investors and, throw, 7+ figures our way for the depreciation. And, then when you put that hand in hand with the most important part, which are the projected returns and then the track record, it is a very well-rounded investment.
I love it. So moving forward, the goal here, it sounds like, is to raise, kind of probably similar amounts of capital for Fund 5. Do you roughly know how long Fund 5 will go for?
Largely goes by, the number of assets that we acquire. So, if Kevin next year comes up with, it's like, fellas, we have to, raise $100 million, then it's going to be, about a year. If I were to make a educated guess, I would say Fund 5 will be open, between 1 to 2 years.
Right. Okay. Very cool. And then, holistically speaking, what's next on the radar for you guys? Are you, going to add any other assets to it, or just stay exactly down the fairway with your two investments?
Yeah, no, staying in the same two asset classes. There's a slight sector still in the mobile home park space that's a little bit different versus what we do that Kevin and Brian are looking into. So I can't share too much about that. However, like I mentioned, if it's not broke, we're not going to fix it.
Yeah.
We're going to keep on doing what we're doing and sticking to what we're good at, which is mobile home communities and parking facilities.
Yeah, makes sense. And then final thing here, I know what you guys do here. We're going to wrap up in this one, but there are some advantages to investing early in the fund, right? Obviously, those who invest earlier in a fund, you are the person who kind of guinea pigs capital because they need your dollars to buy the next wave of assets, right? And then if you invest later, obviously you're de-risking your investment, but you might be leaving a little bit of juice off the table. So you can kind of break down the pros and cons to investing early or investing late, or the incentives associated as the kind of the final thought here.
Yeah, absolutely. So after every fund, we survey all of our investors inside to see, what we're doing well, where we can improve. And, they came back to us and said, overall, you guys are great. However, we don't think it's fair that investors that come in right away, get the same, split and, in essence, the same returns as someone that comes in when, that the train's already on the tracks, distribution's already being paid. We had to admit that they had a good point with that. So, we have different bonus tranches. So the first 10 million that we raise will be at a 76-24 split, and that's for the lifespan of the fund. So even after we essentially de-risk the investment, return 100% of your initial capital, return all of the preferred return that's accruing, and then it goes to that straight equity split, which, for the first 10 million, it's 76-24. And, then the next 10 million, it goes down a percentage and a half. So 74.5. And then the 10 million after that, 73, 10 million after that, 71.5. And then it goes down to that 70-30. So, exactly like you mentioned, it's more so of a thank you for the little bit additional trust, since, it's more so of exactly like you mentioned, like they don't know 100% of the assets that are already inside the fund. So they're more so going off our track record, what we've been able to do in the past. And, going back, another disclaimer, past performance is not, indicative of future success. However, we are, very, very confident that in our projections and, our conservative long-term approach to real estate investing. And, incredibly excited. I've been on phone calls pretty much all day and pretty much all of the last 2 weeks with the current investors who are, investing in Fund 5 with us. So very excited and excited to see where we're going to end up at the end of 2025 and then, where 2026 is going to go.
Yeah, well, I'm super happy that you're part of the LSCRE community. Thank you so much for being a guest on the show. Alex, you're awesome. Where can people find out and reach out and learn more about your fund yourself, maybe working with you guys on Fund 5?
Yeah, absolutely. So we are very active as a team on LinkedIn. So yeah, you can just search my first and last name, Alex Zahn. Or you can go, you can email me directly, alex@scinvestors.com. You can go to our website, scinvestors.com, and, we have a bunch of free material as to, what our investment philosophy is. So, I would say, number one, LinkedIn, you can email me, or you can go directly to our website.
Awesome. Thank you so much for being on the show. For the listeners, we appreciate you, and we'll see you next week.
Awesome. Appreciate you, Craig. Thanks.